Robert, hi. Good evening. Not a good start for the equity markets not a good start for equity market for 2016. What do you make of what happened in China today? And more important, and the bigger question, what does this mean for equity markets going forward?
I think the first point to make is that the announcement of the Caixin manufacturing PMI from China, I think, disappointed expectations. And I think there is increasing skepticism as to whether the official PMI data, which have been consistently higher than this Caixin index, whether those official data, frankly, the credibility is, I think, increasingly being questioned by investors. I think linked into that, one has to recognize, obviously, that prior to this move today, that the Shanghai composite had a significant rally, and if anything, I think it was technically vulnerable to a correction. So although, yes, we've got reasonably good numbers out of China for retail sales for the service sector, and one shouldn't forget that the service sector PMI numbers were pretty satisfactory. Investors have been focusing on this negative manufacturing PMI number. I think there's also some concern about the downward movement in the currency. The renminbi is currently trading at about 6.5. I think there is a very clear consensus that as we go into late first quarter, beginning of the second quarter, that we could easily see the renminbi between perhaps 6.6 and 6.7. So that in turn, I think, has a negative impact on capital flows into China.
Okay. Robert, hi, good evening. The worry also is that, the ghosts of last year's past have come to haunt us once again at the start of this year. So the fear is whether we could head into a bear phase for equities, at least in the first half of the year. Would that be a reasonable assumption to make, or do you think this is just a one-day issue?
I don't think we're going to go into a significant bear market. And by a significant bear market, I'm sort of looking at MSCI World down 20% or more from current levels. I do think, however, we could see in the first half of 2016, what I call a very unsatisfactory market, whereby, we have 1 week up, 1 week down. Obviously, this week we started the year with a significant down week. But if one looks at the trend, I think if one looks at the trend for MSCI World as a whole, probably it's going to be a rather flat trend. And, we have to recognize that there are some quite serious constraints on equity markets going forward, namely a probable further increase by the Federal Reserve in the Fed funds rate in March or April. I think sort of somewhat weaker data out of the States, the slowdown in China, and, one has to remind oneself of the IMF forecast for China this year of 6.3% growth, and I think that's a realistic forecast. Plus, obviously, the impact on the global economy of very weak commodity prices. Now, there are certain markets and certain economies like Europe and like India which benefit from lower commodity prices, but these low level of commodities are causing quite significant disruption to parts of the capital markets and other economies, such as, for example, Brazil, which remains in recession.
Okay, but what about India, Robert? Because, we had a fair year last year, though the second half was not good, but overall it was still a decent year. What's your outlook for 2016?
I think the outlook, in fact, for India is fairly benign, and whereas we've got China clearly slowing down, I stick to my view that India should hold 7% growth, and that is one of the few bright points of the global economy. Obviously, positive factors are that inflation in India should stay low. I think that allows the RBI to keep interest rates low or possibly even go lower. Commodity prices, as we mentioned, are a significant positive for the Indian economy, and most particularly this low level of energy prices. So I think that, although in the second half of last year, I think investors were, concerned about political events in India, and clearly political issues do not go away. I do think that overall capital flows should come back into India, and a market which looked reasonably expensive 6 months ago is now looking more fairly priced. So I think the downside risks on India are now rather low. Having said that, one can't ignore the global backdrop, which is frankly rather mediocre.
All right, Robert, we'll have to leave it at that, but thanks so much for your thoughts. Well, those are two views coming